Sandeep Bhatia, Head of Equity India and Country Head India at Macquarie Group, joins us now to talk about his view on the market and, of course, all the larger cues that we have upon us. Sandeep, hi, good morning. It's been a good Diwali so far this year. And now, in the run-up to the elections, the mood is quite positive in the market. Do you think we could hit new highs before the elections in May? And what are your thoughts on how to approach the markets now?
So I think we would hit new highs if we see continued decline in US interest rates. And that's, as even the Fed says, quite data dependent. But this market is fundamentally poised to be still in a range until we see clarity on where interest rates in the US are headed for the whole of next year. And I think it's difficult to see that clarity emerge, at least in the first quarter of the next calendar year. So we will have to wait and see for a clear trend on US Fed rates until we see new highs in India. But right. Of course, not a big downfall or not any kind of big concern here.
Okay, hi Sandeep, good morning, good to see you in. So that's about the global queue, but the big local queue is going to be the state election results, and we're going to be getting that, say, in around 10, 12 days from now. The current market setup appears that we're factoring in the ruling government, that's the BJP, does well in all the state elections as well. What's your take? If that is the outcome, with the BJP regaining control in most of the state elections, do you think that will be an additional reason for the markets to move up? Or do you think all eyes are only on the 2024 central elections?
I would not be so sanguine and optimistic on the state election outcomes as far as BJP is concerned. I think in two large states in central India, there could be a negative outcome for BJP. Whatever that may be, it will not mean that the whole market prognosis of 2024 final general elections can change. We have seen that state elections have limited impact. And to that extent, whatever happens in the state elections, and as I said, there could be two states where BJP could not be a clear winner or could even be on the losing side, one would not get so perturbed. And I think the markets will also be able to take it in their stride.
We've all been waiting for banks to start outperforming. Despite everything going for the financial sector, we've seen private sector banks lag the overall market. What are your thoughts on the fundamentals and the price action that we've seen in the private sector banks?
Great question. I think the banks were the consensus pick. Everyone, every Tom, Dick and Harry had banks in their portfolios. Fundamentally, nothing has become so negative that the price performance has been weak. What has happened is that the RBI is moving towards increasing risk weights, and all this essentially still means that in the near term, there could be margin pressure, return on equity could come off, and these kind of pressures would emerge. If we, as I said in the very beginning, if we see a clear trend or rather we see a clear downtrend in the US Fed rates, banks can emerge as outperformer again in the second quarter onwards for next year. Post elections, I would think is a safe zone for banks to come back. In the near term, this market fundamentally remains range bound, waiting for more fundamental cues to appear on the politics front in India and the global interest rate front in the US. That's where we are. So not in the near term. I don't expect major positive price action by the banks in the next 3 to 6 months.
Okay. There's some very interesting developments in the primary market, right? A lot of IPOs in these new and emerging spaces are coming through, whether it's IRDA in the renewable energy space, whether it's Tata Technology in this whole electrification space, or even, some of the others in the fintech space as well. Which are these new spaces that you like from a long-term investor standpoint?
I think these new spaces essentially are giving you more options in the market. For a large cap foreign investor or a large cap domestic investors, they would be a marginal part of their portfolio. For retail investors, yes, you could see them coming through. The one thing which I'll emphasize on all these IPOs is look at the quality of the management, and more importantly, whether they are able to build a sustainable business. We see that some of that is happening. We like delivery in the newly listed space. We continue to look at with interest with Nykaa and Zomato, but we are more cautious on them. But clearly, what is important is A, the quality of management, and also whether they can sustain the downtrend. This kind of IPO boom that we are seeing would probably continue at least till the Feb-March period, and then we shall see where we stand.
Sandeep, ultimately it's going to be all about earnings, right? And going by what we have seen in the first half of the year, the run rate for the Nifty earnings for the second half of the year is pretty much gettable. I think it's high single digits to maybe around 8 to around 10% approximately. So FY24 appears to be in the bag with regard to earnings. The challenge is, can we see mid-teens earnings growth for FY25? Do you believe that's possible?
By mid-teens, if you mean over 16%, I think that's
15,
a bit of a
16%.
stretch. I would bet on a 14% between. I think a 12 to 14% is what we will see. There's been clearly, pressure coming through in some parts of the economy. The rural markets are still very weak. So if we see a broader consumer rebound, then probably 16% plus can come through. But if you see the same kind of earnings, and there's clearly banks are a very large contributor. Other PSU companies are also large contributors to Nifty earnings. So if it's just the same sectors that have contributed to earnings in the current year coming through in the next year again, then 16% plus would definitely be difficult. I think the real thing which is happening in India is the widening of the market, and the IPOs are one indication of that. Of course, they don't contribute to the large index earnings, but definitely the widening of the market is a very good thing.
Sandeep, people are comparing the current real estate upcycle to one that happened close to about 2 decades ago, which lasted for a long while. And now we are seeing local players, not local, but players having pan-India aspirations. Where do you stand on this real estate cycle, and are you convinced that it can last for the next 4 or 5 years?
I think real estate has been always asset class of a lot of interest to smaller retail investors in addition to financial assets. We've seen that in India for a long time. As far as real estate is concerned, for large commercial real estate or large buyers of real estate in India, I think yes, they will continue to be interested. The interesting thing which is happening is that Indian cost of funding now in rupee terms is which was significantly higher than the US dollar funding for the last 20 years, now is much more comparable. Of course, Indian rupee dollar funding rates are still slightly higher, but if you add the hedging cost and if you borrow in US dollars, actually they are very much the same. So essentially it means that the real estate funding which will come through and the purchases will come through can also be funded not necessarily by cheap US dollar funds, but also by Indian funds. And that probably is a good source of funding for the longer term. As I see it, the economy remains strong, and as long as this economy remains strong, real estate will continue to be a outperformer. The good thing, as you mentioned, is that now we have pan-India developers, and the quality of the build-outs, the quality of those businesses is superior. So hopefully this cycle can last longer.
Okay. By the way, Titagarh Rail Systems is really the stock of the moment on the back of that agreement with ABB. Titagarh is up almost 11% now, and the management is also very confident. So, just keep an eye out on that stock. And Latent View is something that's also up almost about 6.5%. Before we let you go, Sandeep, earnings season has come to an end. What was your key takeaway from earnings this time? Have you raised your estimates for the full year? And which are the pockets where you think that there could be more, there could be some follow-on earnings growth in the second half of the year?
I think key takeaways from earnings is that they are moderating, and they would continue to moderate for the next 6 months until we see a bigger leg up. Finance costs are going up for businesses. Margins need to be monitored. Margins have come under pressure. The broader economy is strong, but now plateauing, and it needs another leg up in terms of making this last. Hopefully, the political uncertainty will resolve itself post-elections, and that will give some fresh impetus. What is now necessary is that the consumption cycle kicks in, a broader consumption cycle kicks in for this economy. You have seen investment being driven primarily by the government, and we should see a broader consumption come through post August, September next year, and that would be good for the market. So the market is waiting for fresh fundamental cues to go to and break into new highs.
Okay, all right. Sandeep, final question before we let you go. There have been two sectors that have done very, very well. One was railways and the other one was defense. And both those two sectors, they're still looking up. The industry is looking good. Most of the order books as well are looking good. The problem is now it appears the stock prices are factoring in big earnings growth, say, for the next 3 to 4 years odd. How do you approach that space?
Again, great question. I think while we don't have direct coverage on these sectors, one thing I will say, as I said in the course of this discussion, is that widening of the Indian market is happening, and this is the defense sector, the railway sector is part of that widening. What we need is continued momentum. But as you said, the earnings are fully priced in, so there could definitely be a leg down in all these stocks. It doesn't mean that India's build out of railways or the defense sector build out will go away. So if there's any leg down, I would be definitely looking at entering these stocks.
Sandeep, great conversation. Thank you very much for joining in.